Welcome to Chapter 14, Financial Analysis, the Big Picture. In this specific chapter, we're going to look at things such as sustainable income, quality of earnings, how to apply horizontal and vertical analysis, and analyzing a company's performance using some of the basic ratio analysis. This chapter focuses pretty heavily on sustainable income. And this is the amount of income that a company is likely to be able to continue to obtain into the future. It disregards things such as unusual revenues, expenses, gains, and losses, and information on those items is typically found on the income statement and other comprehensive income. So here we have the statement of comprehensive income. As you can see, we have sales revenue, all of our normal expenses, so on and so forth, to give us income from operations. This is other revenues and expenses. This is our income before taxes, our income tax expense, and then our income from continuing operations. So what we can expect here is $146,000 from continuing operations. Now, there were some discontinued operations. Those operations will not be obtainable in the future. No longer are we performing those tasks. So these are the types of things that we know are not a part of our sustainable income. The income statement provides information on the sustainable income by separating those operating transactions from the non-operating ones. Provides some information on the unusual items such as gains and losses, discontinued items, and the other components of other comprehensive income. Two unusual items on this statement were discontinued operations and other comprehensive income. Those are reported net of tax. Discontinued operations refers to the disposal of significant components of a business, such as stopping an entire activity or eliminating a major class of customers or no longer producing a specific type of product. It's where we have made decisions that will have impacts on things not only now but also into the future. The income or loss from discontinued operations consists of the income or loss from operations and the gain on the disposal of any components. Discontinued operations section reports both the operating income and the gain applicable, net of applicable taxes. So let's just take a minute and we're going to look at an illustration on this. So during 2020, Acro Energy has income before income taxes of $800,000. During 2020, Acro discontinued and sold the unprofitable chemical division. The loss in 2020 from the operations of the unprofitable chemical division is net of $60,000 taxes, $140,000. The loss on the disposal of that actual division, net of $30,000 of taxes, was $70,000. So we start by assuming that there is a 30% tax rate on the income. So we have our income before income taxes, our income tax expense, then our income from continuing operations. So this right here is where we're saying, based off what we will continue to have going forward, this is the income we generated in this year. Based off in discontinued operations, such as the discontinuing of the chemical division, here's some impacts from that in this current year. We had a real $140,000. We had the $140,000 loss, net of $60,000 of income taxes, and a loss of on the sale of the actual chemical division of $70,000. To give you a little bit of additional insight, there are a lot of companies that have what are called restructuring charges. This happens when they're trying to reduce costs. They might label these items in their income statement as non-recurring charges, to provide the suggestion that they're isolated events which are not as likely to occur in the future. If a company takes a large restructuring charge, what is the effect on a company's current income statement versus future ones? Why don't you take just a second to think about that, and we will talk about that here in just a minute. How that would reflect in current and forward. So our current period net income would be diminished by that large restructuring charge. And so our net income in the current period would be reduced significantly. However, in those future periods, because of those cost savings, our net income could be enhanced. You're going to see comprehensive income fair amount in this particular chapter. What that includes is things such as gains and losses that bypass net income. They're sometimes not reported as a part of a more inclusive measure. And it is the sum of net income and other comprehensive items, such as the unrealized gains or losses on things like the available for sale securities. Another thing that could have an impact is a change in accounting period. When that occurs when the principal used in the current year is different than the one in the preceding year. Accounting rules allow a change when a management can show that the new principal is preferable to an old principal. Impacts may be also reflected. So let's look at Stasi Corporation, who purchased IBM bonds for $10,500. It intends to sell them sometime in the future, so they're available for sale. At the end of 2020, they're still holding on to it, but the market price is now $8,000. Stasi is required to reduce the recorded value of its IBM investment by the unrealized loss of $2,500. The question is, should Stasi include this unrealized loss in net income? For trading securities and for available for sale securities, there is some difference in how we look at these. So Stasi didn't purchase this investment for trading. What they purchased it for was for an available for sale purpose. So we show net income of $300,000 and then an unrealized loss on the available for sale securities net of $500 taxes of $2,000, giving us comprehensive income of $298,000. This $2,000 will show on the balance sheet as accumulated other comprehensive losses. This will remain until these losses are actually realized upon disposal of the security. Just to give you an illustration of how this would work, so we have PACE, we have all of their normal operating activities, and those are up here. So we get $46,200 in income from operations. We have some losses that occurred from discontinued operations here, which reduces us to $39,200 in net income. The other comprehensive income, which we do report as an inclusive nature, however, it is not reducing our net income in this period, has an unrealized gain on available for sale securities net of income taxes of $10,500. So this is income we're not going to be taxed on yet, but we're expecting to be. Some of the things that you might find related to changes in accounting principle are changes in inventory cost methods. Companies report most changes in accounting principles retroactively to provide adequate apples to apples comparison one to the other. Now let's talk about things such as quality of earnings. You're going to hear quality of earnings a lot. That's something the analysts toss around, the accountants toss around, finance managers, all of them. So in evaluating the financial performance of a company, the quality of the company's earnings is of extreme importance to our analysts. A high quality of earnings provides full and transparent information that will not confuse or mislead users of the financial statements. Now remember, the two main users of financial statements are the creditors and the investors. Factors that might affect quality of earnings are things such as alternative accounting methods. This is variations among companies in the application of the generally accepted accounting principles, and they can hamper things such as comparability and reduce the quality of earnings. Some examples of that are FIFO versus LIFO inventory cost flows, straight line versus declining balance depreciation. Pro forma income usually excludes items that the company thinks are unusual or non-recurring. Many analysts are critical of using the pro forma income because these numbers often make companies look better than they really are. If there is improper recognition due to the process from investors to continually increase earnings, some managers have manipulated their earnings numbers to meet these expectations. The most common abuse is the improper recognition of revenue. There have been many scandals over the years related to a variety of improper recognitions. You will be exposed to a few of them in these texts, but one of the things to keep in mind is that these are the anatomy of a fraud. These are the things not to do. We should not be channel stuffing. Another way that management may manipulate the quality of earnings is through the capitalization of operating expenses. Our friends at WorldCom were very guilty of this. So has been Waste Management and a few other companies off the top of my head. And a failure to report their liabilities. That is where Enron comes in. And as you are all aware, Enron was a serious issue, a serious accounting scandal. It took out one of the top accounting houses with it, and it was the impetus for the Sarbanes-Oxley Act. I want you to take a minute and I want you to look at this. This is the do it for unusual items. Go ahead and press pause so that you can take the time to read this. Here is the actual income statement. As you can see, based off the statement of comprehensive income, when we go from income before taxes all the way to comprehensive income, we have a clear delineation between those items that the company sees and views as being unusual, non-recurring, not going to impact the future periods, where the $280,000 of income from continuing operations reflects those things that we will continue to carry into future periods. We still have those assets. We still have this plan for these types of transactions. Now we're going to go ahead and stop this lecture here, and then we will pick up And we'll do the vertical and horizontal analysis together in the next lecture.